When you look at investing, there are various financial products for you to choose from. Investors put their money keeping in mind a lot of factors like risk factor, the financial goals and much more, with one goal of getting the highest possible return on their investments. But can you grow your money better? Well, the answer is yes. Hello and welcome. I am Pallavi Sharma and you are watching Money Wise with ET Now. In this video today, we tell you how to get the best possible returns on your investments and when is the right time for you to start investing. Let's start with risk profiling. An investor's risk profile is their willingness to take risk while investing. Depending on how much risk they can take, investors are put in three categories. Number one, aggressive investors. These investors are the ones who have high risk appetite. They invest in products like equity mutual funds or credit risk debt funds. Number two, conservative investors. These investors have low to no risk appetite. They invest in products like fixed deposits, bonds, debt mutual funds and small saving schemes. Number three, moderate investors. These investors have risk profile between aggressive and conservative investors. They neither take high risk or low risk. They consider investing in hybrid mutual funds. Let me explain this to you with an example. Say there are three investors A, B and C choosing to invest in an SIP with rupees 5,000 per month for 20 years. A, with an aggressive risk profile, expects a return of 12%, invests in equity mutual fund. B, with a moderate risk profile, expects 10% and invests in hybrid mutual fund. C, with a conservative profile, invests in debt mutual fund and expects a return of 8%. As per this calculation, the accumulated corpus after 20 years for A will be over 49 lakhs, B will be over 38 lakhs and C will be over 29 lakhs. So higher the risk, the more returns you get. Coming to your financial goals, investors are divided in three categories. People having short-term goals to be achieved within 3 years. Examples include building an emergency fund, buying life insurance, creating an annual vacation fund and more. For this, investors invest in debt funds and other fixed income instruments. Now, there are medium-term financial goals. These are achieved within 3 to 10 years. Examples include accumulation of funds for house down payment, purchasing a new car, starting a new business and more. Investing in a hybrid mutual fund is advisable for medium-term goals. For long-term financial goals like building fund for child's education, marriage, retirement, etc. To be achieved beyond 10 years, equity mutual funds are a better choice. Now these give you higher returns. Now the general rule is higher the investment time horizon, higher will be the return. Let me explain this to you with a similar example. Now say A, B and C decide to go with investing in an SIP of rupees 10,000 per month in equity mutual funds for 10, 15 and 20 years respectively, and they are expecting a return of 12%. Calculating the accumulated corpus, A will earn more than 23 lakhs, B will earn over 50 lakhs and C will earn over 99 lakhs. Investing in stocks also for a long term gives you better returns. Let's look at the Nifty 50 index return based on investment time horizon. On a daily rolling basis, investors who invested for 10 years in stocks got 47% of the time they got a return over 15%. Investors who invested for a shorter period got 37.5% of the time they got a 15% return. So starting to invest early is always better. People who have just started investing sometimes tend to ignore the power of compounding. Say you invest rupees 500 per month in an SIP offering an annual return of 10%. After 4 years, you would have invested 24,000 rupees. Your returns after 4 years will be over 29,000 rupees and the profit earned would be over 5,000 rupees. But if you invest the same amount for 6 years, you would have invested 36,000 rupees and your returns would be over 49,000 rupees and the profit will be over 13,000 rupees. So this means if you invest just for 2 more years, you will get a 41.63% more return, and the difference will be more than the accumulated profit you earned in 4 years. This is the power of compounding. Interesting, isn't it? So stay tuned to 18 Hours YouTube channel for more such interesting videos on how to manage your finances.
If you like this video, then like, share and subscribe to ET Now.